This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. We try and bring you regularly business, investment, technology, startup news. We hope you enjoy it. Thank you for listening. Today's discussion is the big banks and money managers versus the private equity funds. So here's what's going on. Over the past bunch of years, the private equity funds had largely as a stock class outperformed the banks and the big money managers. That has reversed dramatically this past year, and we'll just give you a quick sense of it. So Bank of America and Morgan Stanley just reported great results for the last quarter, but in terms of their stock, B of A is up nearly 19% year to date. Morgan Stanley's up nearly 30% year to date. Another big money manager, really the biggest of them all, BlackRock, they're near about 13.5 trillion in assets now under management. It's up 17% year to date. So those are sort of the big banks, some of the big money managers, just all doing really well in the black from a financial and stock market perspective this year. Private equity funds are telling a different story. The biggest private equity fund, Blackstone, is down 5% year to date, and then KKR is down 15% year to date. And at the end of the day, it's basically due to different business models. The private equity funds really do well when they're able to exit businesses. The huge money managers do well as long as there's trading and activity going on, deal activity going on. And then, of course, BlackRock gets really a percentage of assets under management. It doesn't get as high a percentage as the private equity funds, but it's not reliant nearly as much on exits to make money. So the private equity funds are suffering compared to the big banks and the big, huge wealth managers. That's what we're watching currently. Thank you for listening to the Becker Business and the Becker Private Equity Podcast. Thank you very, very much.